Market structures, monopoly, demand, and the MR curve, take 3. Hey everybody, welcome back. We are on market structures and we're turning the page to monopoly, okay? So we're looking at a monopolist now. And the first video I think is the most important video, is the one that we're on right now, and it's the one where we totally explain the relationship between demand and the marginal revenue curve. Now I wanted to say right from the beginning, we've got an assumption out here. We're assuming no price discrimination by the monopolist. What does that mean? It means the monopolist is going to charge every customer the same price. Whatever price they put out there, they're going to charge every customer that price. Does that hold in the real world? Not always, but it's not the worst assumption, okay? In a lot of ways, it does hold in general many times, okay? Not always, of course. But it's not a big assumption to get all bogged down in, okay? So just remember, we're assuming no price discrimination. We're charging every customer the same price. Now here's what we've got so far, okay? I've got a demand schedule already put on the board, and I've gone ahead and graphed this demand schedule right here. Kind of back up out of the way. I just don't want to come out of frame right here. You can see the demand curve. So we've taken this schedule, graphed it right here. Now I just want to very quickly go over something we all know. I want to just go through this very quickly. So what we're saying is, if we get the price to $10, the price is $10, only one person has the ability and willingness to buy it. Notice that demand language, okay? However, if we lower the price to $9, now 2 people have the ability and willingness to buy it, okay? That original person plus somebody else. If we lower the price to $8, 3 people now have the ability and willingness to buy it, and you know where I'm going with this, right? So keep lowering the prices, the quantity demanded increases. Once again, that's the demand schedule. It gives us our information for the demand curve. But what we want to now do is talk about the marginal revenue curve. So I've added in 2 columns, a total revenue and a marginal revenue column. So here's the situation. If we do charge that $10 price, we're only going to sell one, and our total revenue, pretty straightforward, right, is $10. And therefore our marginal revenue, remember, we're going from an output of 0 to 1, okay? By the way, what is marginal revenue? The additional revenue we get from producing one more good. So we're going from 0 to 1. Well, if our output was 0, our total revenue would have been 0. And now our output is 1, our total revenue is 10. That means marginal revenue was 10. Now, let's pause for a second, because we've actually now got a dot on our marginal revenue curve. What gives us our marginal revenue curve? What's the relationship between? It's between output and MR. So between this Q and this MR gives us the marginal revenue curve. I like to very much show us that between Q and MR, that is giving us the MR relationship, the MR curve. So with that knowledge, take a look at this, y'all. $10 price, one person's going to buy it. $10 price, one person's going to buy it. At an output of 1, the marginal revenue is 10. At an output of 1, the marginal revenue is 10. So these dots are in the same place. The dot on the MR and the dot on the demand curve are the same at an output of 1, but that's not going to continue. Back over to here, right? We want to get 2 people now to buy it. We're going to have to lower our price to $9, and we're going to charge everybody $9. So $9 times 2 gives us a total revenue of 18, and a marginal revenue, an additional revenue. Well, what's our additional revenue? It's 8. And this second row is the beginning of a very important thing for us to take note of. Look at this. The 9 to 2, at $9, 2 people are going to buy it, but at an output of 2, MR of 8. What does that mean? I go to this output of 2 right there, and my MR is 8, so I go vertical to 8, and I get a dot right there. Notice, y'all, the MR and the demand curve are no longer the same. In fact, the MR curve is underneath the demand curve. Let's keep going with this. Let's make sure we've got this. To get 3 people to buy it, we got to lower the price to 8. We're charging everybody $8. 8 times 3 is 24. My additional revenue, my marginal revenue is 6. So at an output of 3, I get 6. An output of 3, I'm going to go up right to here. I get 6. I draw that right there. look at the MR. It's actually splitting away from demand at an increasing rate. It's actually at twice the rate in absolute terms, okay? Let's go to the next one. We want to sell 4 units of this. We're going to have to drop the price to 7 for everybody. So 7 times 4, 28 for a total revenue, a marginal revenue of 4. That means at a Q of 4, my MR is 4. At a quantity of 4, I'm moving up to MR right here about. So anyhow, of course my graph never works out quite the way I want to, but that's good enough. Let's keep going. Total revenue, if I drop the price to 6, 5 people buy it, total revenue of 30. Marginal revenue of 2, output of 5, MR of 2. Let's do this right about there. Drawing that down. There's my MR. Keep going. 5 times 6, also 30. My additional revenue is 0. Okay, that's the worst looking 3 ever, but anyhow, that's a 3. 30 and 30. So my additional revenue was 0. So now at 6, my MR 0 right there. And we're just going to keep going just like that. There is my MR curve. Just a little side note. Just want to throw it out there right now. Guys, right there at an output of 6, that's where your total revenue is maximized, right? If your MR is positive, your total revenue is going up. At this point, our total revenue is going to start going down. Let's take a look at it, okay? Watch this. 4 times 7, that's 28. Yep. MR negative 2. Look at the total revenue starting to go down. That 30 is still kind of bothering me. Let's make it a little bit cleaner. There we go. We can see that happening. We could fill out the rest of the table, but we don't have to. We've gotten what we really want to know. We have gotten now a visual of the MR breaking away from the demand. That's how I like to say it. It's breaking away at twice the slope in absolute terms, okay? So we've got MR lying underneath the demand curve for monopolist. Why is that the case? Because the monopolist is the market. The monopolist faces the market demand curve, a downward sloping demand curve. Market demand curves are always downward sloping, and the monopolist is going to face that downward sloping demand curve, and therefore their MR curve is going to break away at twice the slope. Anytime you have a firm that faces a demand curve for their products that is downward sloping, their marginal revenue curve, assuming no price discrimination, will be underneath the demand curve and will be breaking away from the demand curve at twice the slope in absolute value terms. All right, guys, that was a big one, but if you got it, it's going to make Monopoly so much easier. Just stay tuned for the rest of the Monopoly videos, and you're going to see, hey, it's pretty easy to do. Thanks for tuning in. We'll see you in a future video.